Well, welcome everybody to our Straddles and Strangles webcast. I'm Connie Hill. Happy you would join me here today. Last week we picked out a couple of stocks that we did one straddle, one strangle on the other one. They moved so big that these were great examples. So hopefully you did those in your paper money account. If you didn't, that's okay. We're going to review what happened here with those in just a few minutes. Now, I am joined in the chat by Cameron May. Happy Cameron's here. He's a fellow coach and friend. He's been involved in the markets for such a long time, and I know lots of you like to go to his classes. He's here to help me answer your questions. So go ahead and chat him in. I'll keep my eye on the chat. Cameron will as well. And you might have to catch some things that I can't quite get to. So appreciate having him here today. Now, I hope you're following us on X. I'm Connie Hill CS. Cameron is Cameron May CS. We'll post different things we're noticing about the markets or charts that we think you might be interested in. So it's free. Follow along. You're welcome to do that. Would love to see you there. I will mention it's also a way you can communicate with us, which we have just limited ways that you can do that, but having an X account allows you to do that. Well, let's go through our disclosures and lay out our agenda and get with it. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for education and information only. Don't consider it a recommendation. We'll be using the paper money software application here today. It's a great educational tool and it's a great tool to just practice different strategies with. One thing that happens in paper money, or it's a good replication of what happens in your life account, but there are some variances. And one of those is that short options will not be assigned early in your paper account, but in a live account, they certainly could be assigned early. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. All right, want to make you aware of some upcoming workshops. So Denver's just in, not this coming weekend, but the next will be Denver. Then we've got Dallas for an advanced options workshop. We do those not as frequently as we do some of the other workshops. So if you're kind of feeling pretty good about your basic option strategies, the advanced workshop might be the place you're interested in. And then we have one in Boston. So if you can join us, they're free. We're so nice to you. We feed you. We pay your parking. So it's a pretty good deal for you. And of course, it's free for you to come to as a Schwab client. All right. We want to look and see what happened to the trades that we put on last week. So we are going to do a review of those. And in this class, reviewing how we manage the trade is really critical. It's fairly easy to decide what, to put a trade on, but it's the managing of the trade that really has all the details that I think you need. So I like to spend some time going into detail about how we manage different trades. So we're going to do that. And then we're going to put on some new ones as well. All right, let's look at the ones we did last week. So let's head over to Thinkorswim. Looks like the market still is up a little bit today, had a little bit of a bounce, up 1% or so. Let's see, the VIX ought to be dropping then, not up in these high territories, but it's still above this 23-ish area. And we kind of look at 20 or higher as having more volatility. So even though it's pulled it back the last couple of days, we still have quite a lot of volatility in the markets. All right. Our first trade that we worked on last week was Oracle. Now, I always encourage you to paper trade along with me because that's where you have questions that come up. As you're doing the trade in your paper account, well, then you might have a question. You can say, hey, what about this particular thing that happened during this trade? Okay, so I encourage you to do it. Now, we did on this one, I believe we did a straddle. We'll take a look here at the numbers. And we're looking for, it was long, so we're looking for a really big move. And so this stock, at the time it was out there, it looked like the market maker move was 10.87% is what I had written down on my notes. Well, what is the market maker move? Well, it's really just what the market makers have priced into the at-the-money options. And the idea of this is what they're expecting the move to be. Now, it's not guaranteed that it's going to be exactly what it's been priced into it, but at least it gives you an idea if markets are looking for a big move or a small move. Okay. In this case, it was looking for 10+% is looking for a fairly good size move. Now, our market maker move is still here on the chart, and not all stocks will have a market maker move, just so you know. Now, I do want to make sure you have this script, all of you. I call it my market maker move on the charts is what I call it, okay? Those of you that are here in the chat, I'm going to push it on over to you, or those that are here live. Those of you that are listening to this on a recording, let me go ahead and put it in a spot for you. And I should mention, those of you that are listening to this on the recording and aren't here live, what you need to do when you have a question is just put your question in the comment section of YouTube, because I go back and look at those every day and see what questions you might have. Okay, so that is what that little URL is. Remember, anytime we share a script with you, it's never guaranteed as to accuracy or timing. All right, so here is, we're going to just kind of zoom into Oracle here. We did our trade on the 9th, which was right here. They had another day of trading before they announced, and then they announced that night, which was the 10th, I believe, and it was after the market closed. So the reaction to the news is what we're seeing between where it closed here and where it opened up the next day up here. And it was a pretty good size move. You're going to see this white line that I have on my chart here. That white line represents once they announced and the news was out and we had, a little bit of time for the market to react to it. That's where the price was sitting when I finished looking at it that afternoon. Okay, so they announced their earnings. We saw a big move up. Now, for the rest of our discussion, I'm going to zoom into a shorter term chart here. And I'm going to go 5 days and 5 minutes because I kind of want you to just see how this all looks. So we're going to go out here to our 5 days, 5 minutes. This is probably a bad data point. Don't worry about it. So here, where it's black, that's the actual trading day, market hours. The gray is the intraday, or I take that back, not intraday. The before the market and the after the market prices. This extended hours is highlighted here so that we can tell the difference. So here was the earnings. I'm going to zoom in here. I'm going to zoom in about like that. Okay. So after the news was out, you could see this big move that it made. And this is a 5-minute chart. Sometimes I might look at a 1-minute chart when it's actually going on, but for our purposes here today, 5 minutes will be just fine. And then you can see it kind of stayed that way. And I put my line here about what the price was when I stopped looking at it. And it looks like it was about this 163-ish. And then the next morning, let's come on over here. The next morning, it was still up, well above that 163. So the market opened, we had a big candle, nice big candle of movement, and that was even beyond, so it was a nice gap up, and then a continued move, all right? So what did we do on this? I'm going to take you over to the account statement. We're going to work on some numbers here. Let's see here. We put on, oh, this one was actually a strangle. I told you it was a straddle. It was really a strangle. I forgot. I had you guys vote on which one you wanted to do, and the class voted on a strangle. So that's what we did, which means we went a little bit out of the money with the options that we bought. When we do a straddle, it's the at the money, and both strike prices are the same. On a strangle, we go out of the money a little bit, out of the money to have maybe a little bit lower price as far as the entry price goes. But the kind of the trade-off there is that the break even, because we take the total of what the premium is and add that to the strike price, the break evens actually could be a little bit wider than what they might be on a straddle. Okay, and that's just kind of generally speaking. All right, so we paid $19 as we got into this. Okay, so that's basically money out the door. Now, the next morning, when I saw that it looked like it was still going to open up, I went out and I put on a stop limit order. Many times we'll use a stop market order that says, hey, stock, if you hit this price, trigger a market order, get me out of the trade. First thing in the morning, sometimes those are not the best fills. They just aren't. Okay. Which is just kind of how the market works. And so that's why I did a stop limit. And so what I did here is I said, okay, if the price, let's see, what did I put it on here for? Put a stop at 488, meaning if the price of the stock went lower than that, and I think that's what it was showing pretty first thing in the morning, what it was trading at before the market opened. Sometimes you'll see those option prices update. And then I said, but I want to get filled at $4, which was roughly maybe a little bit less than half of what that option, what we paid for, right? Because we paid $9.75 and $9.25, and it was the call we were trying to get out of because no, that was the put that we tried to get out of because this one really popped up, right? In any case, I wanted this to get filled at $4. Now, a nice thing happened. We actually got filled at 470. Sometimes this can happen and sometimes it doesn't. Sometimes it might work in your paper account and sometimes it might not. So really, it's quite fortunate that we didn't have to totally throw away the put. We didn't have to totally eat 975. We were able to recoup 470 out of it. And that was actually one of the keys to our being profitable on this trade. Okay, so that was done right when options started trading. Then about 20 to the hour, so the markets had been open almost a full 20 minutes. Then it looked like that was fading. Yeah, it looked like it gapped up and we saw it start to fade. And if I go back to my chart here and we look about what that time was, so here's the first 5 minutes, the second, the third. And so this was the candle we technically traded in, I think. Let's see. Nope, let me move over a little bit more. It was this candle. It was this red candle here. The 7:45 was the beginning of the 5 minutes, and we got out at 7:30 or at 7:49. Okay, so we saw it run up here, and then we saw it start to fade. Now, when it's running up, great. We want to milk it for all we can. But when we saw that it started pulling back and started to slide, that's when we said, okay, let's just take the money that we have. Let's just get it and be out, which is what we did. So then we got filled at 1815. So if you add 1815 and 470 together, that gives us a value of 2285. So 2285 minus the $19 gave us a profit there of 385. Now you might think that's a lot of work for 385. And you're right, sometimes it seems that way. On these trades, we typically just do one contract because it's a speculative trade, meaning we're just doing it because we want to possibly take advantage of a big move, even though we don't know if the big move is going to occur and we don't know if it's going to go up or going to go down. So we buy a call, we buy a put. One of them ends up being the big loser. Hopefully the other one ends up being a big winner. And so that worked out actually fairly nice for us. Okay. If you have questions regarding that, let me know. Ooh, we've got a new person here announcing their new Evertha Hubbard. Welcome. I may have said your name incorrectly there, but it's your code name. Yeah. All right, the next trade. Let's move on to it. That one was Adobe. Let's look at the chart of Adobe first. And let's come out here. We'll come out here to say a 3-month chart first. Now, Adobe slid maybe not that big of a surprise because of how software is just being hit all over the place, right? A lot of selling off in the software names. So they announced later in the week. They did not announce until I think this was Thursday night. The 12th, yep, that was Thursday night. And so the next morning, Friday morning, is when we could finally start watching this trade, see what happened. Okay, so again, the night before, they were down pretty decent. This 251.37 is about where it was when I stopped looking at it, okay, that night before. So that gave me a reference point for the next day. Okay, where is it likely to be the next morning? Is it going to be down still? It can always change its mind. It can always reverse, but it was still down. And then I put a little line here where it was in the morning, okay, when it first started opening, just so that as I'm watching it, I have a reference point here. Now, as we see this is a pretty decent drop here, okay? The market maker move on this one was supposed to be, looking at my notes here, it was 6.55%, which I'm going to say is kind of a decent move, but not huge. Okay, Oracle was at 10+%. That means probably really huge. This one is, I'm going to say, a decent move was expected, and it really gave much more than a decent move. Okay, on this one, let's do the same thing. We'll come over, we'll check the account statement here. This one we did the straddle on. So we bought a 280 put and a 280 call, and they're expensive. These are expensive contracts because the stock's expensive. So we ended up shelling out $26.80 on this trade. Now I want you to look at the execution times of the next morning on Friday morning when we got out of the trade. So it was apparent that the call was not going to be good in this case, that we needed to sell it and see what we could salvage. Well, I put in a stop limit here as well. And guess what? It did not execute. I said, you know, if the price of the option gets to $10 or lower, then let's try to get out. And I love to get filled at $8 or better. Well, it did not take. It did not fill us. And so I had to go in and change it. And when I went in to see what it was priced at right then, it was down to 53 cents. It's like, oh, well, no wonder it didn't give us anything here because it wasn't floating in that time all that long. Okay, so what did we do? I had to change it. I had to change that order. I said, get us out of whatever the price is right now, which was 53 cents, and it filled us at $1, which we're thinking, oh, yippee skippy, but it's better than nothing, right? Better than a poke in the eye. Now, the one that did so well was the put. And you can see here, we actually got out of the put like a minute and a half later. And we'll go to the detailed chart and show you. Now, we ended up coming out positive on this trade, not as much as I would like. We ended up coming out about $270 on it, but let's go look at these candles here. Over to our charts. We're going to go to, we might even be able to do the 1 day, 1 minute here. Let's see how that looks. Okay, because it was on Friday. So the let's maybe go to let's go 2 days. We'll go 2 days, 5 minutes. That's fine. All right. This was Friday's trading activity. This was Thursday night's activity after the earnings came out. So you can see there was a big run there for a slight period of time, but really most of the time it ended up being down here. Okay. And it stayed down there. Okay. So the next morning, let's see what happened. I'm going to zoom in here. And really, it's the 5-day candle here. And we traded out of our trades in the first 3 minutes. Okay. So this 5-minute candle is going to be sufficient. This is all the price action we were watching. Okay. So on this one, it did end up being down, but then the next day it looked like maybe it was going to run up, right? You can see where it was and it started to rally up. So that's why we got out pretty quickly, because we had stayed in a little bit longer that morning, we might not have been able to salvage as much as we did. Okay, so that's why we got out so quickly, is it looked like, oh, well, it's been down and now it wants to possibly go up. So these trades are really time intensive. They're really, you have to stay on top of them. Like, don't put them in and go on vacation and think you're going to check it on your phone. Okay. Maybe some of you are that talented and you can do it. Usually when I'm on vacation, I'm a little busy having fun and not paying attention to the markets. Okay. So keep that in mind when you're doing some of these trades, that if you can't pay attention to it the next morning, when the news is going to be able to be reacted to, then you might not choose to do particular trades just because you're not available to, I'm going to call it babysitting, although maybe you're not babysitting that long. Okay. Now, if any of you did these trades with me, go ahead, let me know. I'd be interested in what your experience was. These are not trades that everybody is going to be interested in doing all the time. Okay, because they are more speculative. And they are kind of like, hey, let's just get in on a reaction to something that we think is going to move big. It's not guaranteed to, but both of these were really big movers. And you can see from the first trade on Oracle how important it was that we got about 470 on that option, because that really helped boost our profits here. Okay, so like I said, on Adobe, we did end up being a little bit positive. We've got that 2950 total subtracted from our 2680, and that gave us a profit of about $270. Now, if you had more contracts in here, then the profit would be greater, assuming you traded it exactly like we did for our practice trade. All right, we've got another person here that looks like they're new. Diane. Welcome, Diane, to our Straddles and Strangles webcast. All right, we're going to do some new trades. All right, we still have some earnings going on and we still have some decent movers. Okay, let's come out to the charts here. And we're going to go to a 1-year chart. We're going to come out to old stretchy pants, Lululemon, right? Women are really know this line probably pretty well. Men are like, I don't know what that is. Okay, it's yoga pants and stretchy pants, and they have moved into men's clothing too. All right, now when a stock is getting ready to announce their earnings, some of them may have this big market move. Some of them might not. Okay, you might pull up a stock and look at it and go, well, it has earnings. Why doesn't it have a market maker move? And it's because they're not done on everything. Okay, it's usually the bigger stocks and the ones that have a history of moving are the ones where it's really going to show up. But basically, what this little script is doing, it's going from the trade tab, and it's basically seeing what the market maker move is. Okay, and that's where it is on the trade tab. So this stock is expected to move plus or minus $15.50. We don't know what direction it might go. It might go up, might go down. We don't know, right? So that's why we're trading both sides. That's why we buy a call and a put, is because we're hoping one is a winner and really makes up for the leg that we lose. Okay, so that's where that comes from. And so when we come over here to the chart, it's split it in here, 1560. The actual plus or minus move right now. And it's about 9.7%. 9% is pretty decent. Okay, a move of 9% on a stock is really pretty big. Okay, now what we want to do is see, well, has this stock moved in the past over earnings or not? If it doesn't really typically move big over earnings, we might not want to use this strategy with it. Okay, so Lulu, their earnings are coming up, and they're going to be the 17th after the market closes. So that'll be tomorrow night on the 17th. Okay. In the past, let's look at the moves. And what we're trying to see here is, do we see really big candles or do we see gaps, right? Because gaps are an indicator if something's moving really big. And I'm just going to kind of zoom in on this one area here. This was a pretty decent move. They announced their earnings. Looks like they announced them on the 27th, and they closed at 341. The next day, they opened up at 301. It had a $40 drop. Okay, so yeah, that is definitely a big drop, a big movement on that earnings. Now, their next earnings came up kind of quickly, I thought. And as we look at it here, it had been rallying for a bit, but the night of earnings, it closed here at 330 and change. Next morning, big gap down, and then it continued to drop. Now, in this case, look how many days after that it continued to drop. So one lesson from that is, well, if we buy a little bit of time and we get an extended move, great, that might work to our benefit. Uh, we don't know when it gets this big drop down, we don't know that it's going to keep dropping. It could rebound because we've seen that happen too. So the first two moves, pretty big to the downside and sustained. All right. Most recent earnings, well, I should say the September earnings was here. And again, it dropped. Now, this doesn't look quite as big, but the value of the stock is much lower. Okay. So, yeah, was there a decent gap? There was. And then most recently was December. And so December actually was a nice little gap up, ran up that day and then fell back down. Okay, so quite a bit of volatility here this day. And it kept the gap up. And it looks like maybe the next day it continued it a little bit. Okay. So really, when you're working with it, you don't know how long the move's going to last. You don't know if it's going to retrace. So one thing I'll look at typically is I'll say, where is the bottom of the gap? So on the day that it gaps up, maybe putting a line right there, because the bottom of the gap many times will act as support for the stock. And so that's one of the things I'm watching is, oh, is it staying above the bottom price here on the gap day? Okay. Question here says, how do you determine the number of points a stock move up or down before earnings? Yeah, it's a great question. How do they come up with this number? Really, what they're doing, and we'll see this on Lulu, that it'll be close to that, is we come over here to the option chain in the period where they expire. It's basically taking the straddle information. So let's see, right now Lulu's trading at 160. So that looks like it's going to be the at the money strike price. And so we'd add the put and the call together on the ask price as though we're buying both of them. So 810 plus 890 equals what, about 7? Is that 17? I think that's about $17. And it should be fairly close to what they're showing up here for the market maker move. Now, the thing that's different on this when we're adding up those values together is the expectation of the event only, which is really just for the one day, is what the market maker move is. Whereas the money here, the value of the premiums here, they have 4 days before they expire. And so the expectation of movement's a little bit more. So see out here where it says plus or minus 17. Okay, that's the move that is expected on those options before they expire. Okay, so that's where those values come from. All right, good question. Now on Lulu, we could, it's kind of an expensive stock here. We could do a straddle, or we could do straddle buying the same price, would be buying the 160. And if we did the strangle, we might go a little bit out. Now, honestly, we're not going to use these options. There's a ton of implied volatility priced into them, which makes them really expensive. And there are some times that we sell the straddle. We look to collect that premium. And when we do that, then we typically would use this very front month with the expectation when the earnings comes out, implied volatility collapses as it comes collapsing out of all the option prices across the option chain, then typically it deflates the price of those options, okay? Which is why sometimes people might want to be a seller. But if we come out here to the next week that has, say, 11 days, or out here to 17 days, it's not nearly as expensive, right? So this only has 85%, this one only has 73%. Now in Lulu, we saw with one of the earnings that it kind of ran for a little bit, You remember that big drop? I think it was the second one, and then it continued to drop for several more days. Knowing that that can happen might give you the idea of, well, let's buy a little bit more time just in case we think we want to use it. Okay, let's just in case. All right, so we're going to come out here. We're going to do the March 27s on this one. I think I looked out here at the April seconds, and it this one, it just didn't have as much liquidity. Well, maybe that has enough liquidity here. Let's see what the 11th looks like. I was looking at all the different ones here. We've got $2.50 increments. Got quite a bit of open interest on the put side. We've got decent open interest on the call side, except for this one strike price here. Doesn't look like it has a lot of action yet. I will say we could consider the 17s. I wish there were a little bit more open interest in some of these. Notice how this is 0 open interest, 0 open interest, 0 open interest. Okay, so these are probably new as of today and just starting to bring up have some volume. So like this one here, there's 4 contracts out, but 0 open interest. So it wasn't there this morning. So something's happened here during the day. So we're not going to use the 17s because it's not as liquid as what I would like to see. Now I'll ask you guys, I did this last week. Do you want to do a straddle on it or do you want to do a strangle on it? Do you want to do a straddle where we buy the 160 of both the call or the put, or would you prefer to go a little bit out of the money? How far out of the money would we go? I would be looking to go $5 out of the money is all. So 155 on the put and 165 on the call is what we would do. So I'm going to give you a chance to vote here real quickly, okay? And I'm going to, it takes a minute for my voice to reach you and then for you to be able to respond to my question here. So I'm going to give you just a little bit of time here. So we've got a vote from Kevin says do the straddle. Jessica thinks, actually, I think you typed this in a little bit early, Jessica, was that maybe why not be a seller in this one? And you certainly could. Okay, I've seen 2 straddle. All right, looks like you guys are thinking mostly do the straddle here. So we're going to do it. All right, we're going to buy 160 on the put side, 160 on the call side. So what I'm going to do is when I click on this ask price, I'm going to hold down my key on the keyboard so that it'll put both of these together here. It'll know that it's one trade. So 160, 160, we're buying both of them. It's going to cost us $18.25. You know, and you might say, well, how do you choose? And sometimes it just comes down to, a lot of times, is there enough open interest in the contracts I would want to be working in? If there's not, you might not do it. Okay. Now on this one, we're going to do 2 contracts. I know it's a little expensive here, but we're going to do 2 contracts. And the reason we're going to do 2 is because maybe we might get an initial reaction and maybe we lock in some profits on one contract. And then we hold on to the second one with the idea that maybe it might continue to move. And so maybe we get a little bit more mileage out of that second contract. So that's why we're going to do 2. Again, you'd want to make sure you position size. If it's not appropriate for you in your account to do 2 contracts, you certainly wouldn't do that, okay? Because we always want to make sure we're managing our risk, not risking more than what our account can handle. Okay, most of you said a straddle here, although Virgil is very diplomatic. You said either one works, and you're right. Either one does work. All right, so Lulu, we're doing the straddle. Got 2 contracts in here, and we'll send that in. We'll put it into my bucket called Straddles and Strangles. We'll send it there. Now, I have to tell you truthfully, the ones that I chose as examples today, there were some other ones that were good examples, but I'm going to be off later in the week. And I want to put to use my own advice to you, which was, if you can't watch it, don't trade it something for that day, right? If you don't have the ability to watch it, maybe it's not the best idea to trade it. So I'm going to follow my own advice there. And I did not choose things that were further out in the week. Okay, so I'll be upfront with you about that. if you want to maybe experiment with some, I'm going to bring up a couple of ones that we're not using, okay, that may have big earnings. DocuSign is one. Let's kind of come out here. They're announcing tomorrow after the close as well. They don't have as big of moves. I went back, I looked, and we can see there's a little bit of a gap there. And on this earnings, there was a little bit of a gap there. 10%, 10.42% is pretty hefty, okay? Sometimes it's hard to have multiple ones at the same time open, right? When you're trying to chase down, like say we just did Lulu, it might be a little difficult to track down Lulu and DocuSign and do them both good justice, right? And try to maximize our profit out of it. So it makes it a little bit hard. So that's why we're not doing Docu. There is Darden Industries, DRI. They own lots of food places. The one that I most recognize is the Olive Garden. And you can see they've had some decent moves, not as high, not looking for quite as big of a move, right, at 6.27, but still a decent move. And we can see in this earnings, yeah, that was a really good size gap. We look at this earnings here, it closed here, it gapped clear up here, but then it started to fall. So it just didn't really maintain it after that one. But that might be one that some of you might be interested in. They announced on the 19th before the market opens. So we're not doing that one. Let's take a look at one more here. John says, I wouldn't trade Lulu on earnings. Ooh, give us more information, John. Not everybody, right? These, like I try to stress, these are speculative trades and not everybody is going to be interested in doing them for sure. FedEx is another one that has earnings coming up, and that has been a decent mover at 6.83%. The other trade I want to do here with us and get in is Oklo. Oklo, as of recent, has had some pretty big moves. Now, these guys, let's go to the Analyze tab real quick here on the fundamentals. And these guys are in the utility sector, which we don't usually think of utilities moving a whole lot, right? Usually they're kind of trades of safeties, so to speak. But these guys developed advanced fission power plants to provide clean, reliable, and affordable energy. So they are a utility, but notice here it's converting nuclear waste into usable fuels for its reactors. So a real tie to what's going on with these massive server farms they're creating, right? Server plants and bringing in nuclear as a possibility. I will say our nuclear is totally different than your mother's nuclear was, okay? As far as the nuclear power. So on Oklo, they announced on the 17th as well. That kind of made them not be a good candidate, but we're going to use them anyway. I'm going to have to keep track of them. And on this one, same thing. We're looking for lots of open interest. It's traded 2.5 million shares so far today. And so we want to make sure there's some liquidity out here. And let me open up on this one. You know, if the April 2nd expiration had maybe a little bit more open interest, I may have been more interested in that one. I mean, you go out further, you're paying for an extra week's worth of time. You can see we've got a lot of implied volatility, 108, 110, but the one for this week, notice it's up here at 140, okay? So there could be some people that might have been interested to say, well, I want to sell that premium then. It's a little bit lower price stock. Actually, the spread isn't too bad on that, but we're not going to do the short strangle or straddle there. We're going to come out here. We're going to do the March 27s, and we did a straddle on our first trade, so we're going to do a strangle on this trade. And this is kind of nice because we have dollar increments that we can use. So you get to decide how far out of the money. Now, it looks like 59 would be our at the money. So if we were doing the straddle, would buy 60s on both sides. But I'm going to go out of the money a little bit. We're going to go to, price of the stock is at 59 right now. So let's go out $2. Okay, so we're going to do the 57 put. Again, I'm going to click on the ask price with my control key down. And then that's about a 39 delta. Let's see if we can see a similar delta here. This is about a 39 delta here. And that one's going to be the 63. Okay, so the net debit, because it's out of the money, is a little bit lower. Again, it's not guaranteed. I'm going to do a couple of contracts here for the same reason. Maybe we just take the close out on the first contract if we get a decent move that we want to lock in some profits on it, and then maintain one more contract if we want to see if the trade will extend for us. Okay, so we're going to put it in there. Yeah, Virgil says Oklo has government contracts. Yeah, and if you have a government contract, that always creates some stability. And this idea that a lot of the power that we're going to need might need to come from nuclear energy generation is a kind of a big player right now. Yeah, it absolutely is. Okay, we're going to put this into our Straddles and Strangles bucket, and I'm going to watch these guys like a hawk. It'll be Wednesday morning, because 17th, it'll be after the close when both of them open. Now, I do hope that you're subscribed to our Trader Talks channel, where you can find our information, find our content really easily. When you're a subscriber, you can click on the Trader Talks button. Well, this is basically showing you what you're going to look at. That little icon that's blue in the bottom right corner of your screen right now, that says subscribe. And so that's how you can easily subscribe to the channel. Okay. If you haven't subscribed and then you're out here, you will see a little subscribe button kind of floating up here where my mouse is. Okay. But it just helps you find our content. So after our class is over, we're going to have a bit of a break. Barb Armstrong will be up with trading a smaller account. I know lots of you like to go to Barb's class there. She does a fabulous job. And then you can see the lineup for the day. You can also see playlists for any of our classes. You can binge watch if you would like to on the different classes that we have going on. So become a subscriber. Now, FibZone says, hey, is this also called a long synthetic? And the answer is no. A long synthetic would be, in the scenario, maybe that one of two things we could be like selling the call and buying the put, or doing just the opposite, selling the put and buying the call for something that we think is going to be bullish. And the delta on that gets to be about a delta of 1 is what you're trying to do with that. So no, that one is completely directional. This one, we're saying we don't know which way it's going to go. We're going to play both sides of it. Okay, good questions. Why did I select those strike prices for Oklo? I was trying to go equidistant out from where the price of the stock was at that moment, which was, I think, was $59. And I got a similar delta on each, just barely getting into the 30s. You could do 40 deltas if you wanted. That would be just fine as well. Okay, that's where I took it to, and I was trying to get them to be equal, yeah, from each other. All right, my time is up. I do appreciate you being here today. You guys have had some great questions, and I will encourage you, if this is a strategy that's intriguing to you, go ahead with these example trades and paper trade along with them. That is really the best way we learn, is actually by doing. Okay, you can come to our webcast all you want. We love it for you to be here, but you need to practice what you're seeing so that for you, it starts to become normal. It starts to become second nature. You can answer some of the questions we ask you, and you're just like, yep, I know what the answer is, because you've been doing it. Okay, so I'm going to encourage you to do that. Now, I did not see a survey out there today, but if this was helpful to you, hit the like button on the way out. Cameron and I would love a follow. Cameron May CS, Connie Hill CS, and we'll wrap things up there. Stay tuned for Barb Armstrong at the top of the hour with the trading a smaller account. We'll follow up on these trades next week. We'll see you there. Bye-bye.